Hello everyone, good morning and welcome to our webinar on balance sheets and introduction and the banking industry. This is a part of the series conducted by Mr. Vic Winnie, and I'm sure you'll enjoy it. So without taking a lot of time, I'll just hand it over to Vic. Also, in case you have any questions, you can either write it in the question box or mail it to yashu@enev.com. That's YASHU@enev.com.
Okay, Yashu, are you done? Okay, fantastic. Yashu, thank you very much for that. So like Yashu mentioned, this is the second portion of what we have discussed so far. The first portion was discussing the balance sheet, the income statement. Today we'll be discussing the balance sheet, and we'll also be taking a deeper dive into exactly how the repercussions of balance sheet management are affecting today's banking industry. So without further ado, let's actually get started. What exactly is on a balance sheet? At a very basic level, a balance sheet is comprised of assets, liabilities, and owner's equity. I'll go through each one and explain exactly what a balance sheet does. So as far as the assets are concerned, they comprise of resources that are owned by individuals, corporations, or countries. An asset is supposed to be used to generate benefit for these parties involved. For example, it can be raw materials that are owned by a company, which then utilizes the raw materials to make them into finished products, which it then sells for a certain revenue generator. iPad is considered an asset for a company like Apple, which, after using its raw materials, creates a finished product like an iPad, sells it on the open market to individuals, and generates revenue from it. Cash is even considered an asset because the company can choose to utilize cash however it wants. It can use the cash to buy raw materials, which it then turns into iPads and then sells for revenue. It can use cash to actually just invest its assets in, let's say, equities, stocks, bonds, whatever it feels comfortable. Land is considered another type of asset because it can use the land to actually develop into different types of resources. These assets that I speak of, they can be bought using either borrowed money, meaning you go to a bank, borrow money in the form of a loan, and buy the asset with it, or with quote-unquote own money. And what that means is that the investors who own the company can invest their own money to buy the assets. We'll get into exactly what own money versus borrowed money is in the next couple of slides. So what is a liability? Liability is the next thing on the statement when you're looking at balance sheets. So a liability is a debt or an obligation that a company, country, or individual needs to pay back. This is exactly what I mean by borrowed money. For example, loans that it takes from a bank. When you take a loan from a bank, whether you are an individual or a company, you eventually have to pay it back. Until you pay back the loan, that loan sits on your balance sheet under the liability section. Think of yourself as when you want to go out and buy a house. Let's say that the house costs $1 million. You may or may not want to pay for that house by all the money that you have in your own bank account. So you may actually go to a lender and say, hi, can I actually borrow $700,000 to invest in this house? I will put in $300,000 of my own money. And over the next 30 years or so, I will slowly start paying back the $700,000 that I've borrowed. And of course, I'll add some interest to it. That's how bankers make money, by charging you interest on the money that they lend you. So that's what a liability is concerned. Now, it doesn't always have to be that you have to pay back the lenders. You sometimes have to pay back your employees, their salaries. Sometimes you have to pay taxes. Those are considered taxes payable or salaries payable. All of these payables and outgoing cash flow, which are used to generate assets, is known as a liability. The last section on this sheet is considered the owner's equity. And what the owner's equity means is that, let's say you decide to buy the house like we mentioned in the previous example. The $300,000 that I mentioned earlier, to buy the $1 million home, the $300,000 are considered your own money. You can take that money out of your pocket, the money that you may have saved up, you may have earned, you may have received from a family member. That is considered owner's equity that you can actually put into the house. Same goes for when you're starting a company. When you're starting a company, sometimes you need capital, and the bankers may not be willing to lend you 100% of the capital that you need. You need to have some quote-unquote skin in the game. And the way you do that is by investing some of your own money. And that's what owner's equity is concerned on a balance sheet. So, as what we know so far, what you see here overall, a balance sheet is just a snapshot. When you're looking at a company's balance sheet, it is at a point in time, a snapshot of a company, individual, or country's assets, liabilities, and owner's equity. And as the definition goes right here, you'll see is that assets equal liabilities plus owner's equity. Finally, each of these three sections, the assets, liabilities, and owners, have subsections within them, which I'll get into in the next slide. So, assets, as I was mentioning earlier. If you remember, I said there are some raw materials that you have, which would be considered, part of your inventory or your property, plant, and equipment, which are then used to make finished products. You may even have cash sitting in that you may want to invest in treasuries or some sort of asset yielding, interest yielding asset, which would be the investments. This is considered non-operational because the cash that you're using to invest in these bonds may not be actually geared toward generating returns or assets for your company. It is just a non-core portion of your investment. Finally, you're moving on to accounts receivable. What accounts receivable here means is that once you have actually created an asset, then sold that asset, but let's say you sold that asset on a credit card, meaning the customer paid for that asset using a credit card. Until you actually receive the cash from that transaction from the credit card company, that money will sit on your accounts receivable. And it is still an asset because it is capital that you are bound to receive in the near future or at some point in the future. On the liability side, what this means is that this is the money that you have borrowed, or this is the money that you owe. For example, accrued expenses, like for example, when you have to pay salaries, or the taxes that you accrue through the course of the year, or even accounts payable, meaning that when you buy raw materials, you may or may not pay for those raw materials in cash right away. You may choose to buy them on credit, but even if you buy them on credit, at some point, you have to pay back that credit. You have to pay back the money that you owe the suppliers from which you have borrowed. That's what is considered payment. And finally, if you remember when I mentioned my own money or my own equity, that's what's considered the risk capital. And what the risk capital essentially means is that this owner's equity serves as a buffer between the bankruptcy of the company and the operations of the company. Meaning that, a company is considered to be underwater or gone bankrupt when its assets are worth less than the amount it owes, meaning its liabilities. But at this moment, as you can see, assets are worth more than the liabilities, and the difference between the two is the owner's equity. As soon as this draws down to zero or becomes negative, that's when the company can be considered. I believe you can still hear me from what I'm hearing.
Okay. Yes, Vic, there's absolutely no issue and everyone can hear you. You can carry on.
Okay, thank you. So back to what I was saying, the owner's equity serves as a buffer between the assets of a company and the debt holders. The debt holders are willing to lend you capital because they know that the first loss on the company will be of the owner's equity, and the loss of the debt holders will only be when the owner's equity is down to 0 or less. So before we jump into an example of how exactly the balance sheet management is affecting the banking industry today, let me actually show you how a balance sheet is structured. So on the left-hand side, what you see, these are made-up numbers for illustrative purposes only. So on the left-hand side, let's focus on that first. In the asset section, you have your current assets. Current assets mean that something that is very liquid or can be turned into a liquid instrument like cash within the next year or the next business cycle. That's what a current asset means. So accounts receivable, meaning anything that would sit in accounts receivable, the money that I expect to receive from those who have bought goods on credit from me. If I expect to receive that money in the next year or within the next business cycle, it will sit under current assets. Same goes for inventory, prepaid expenses, and other current assets. Prepaid expense can be something like, okay, I run a brick and mortar store of a clothing company, and I lease the space from where I operate the store. At that point, instead of paying rent for that store on a monthly basis, I'll pay rent for the entire year up front. That's where a prepaid expense would be considered an asset, because I've already paid for the rent for the entire year, and for each month that I actually accrue that rent, that prepaid expense comes down. Long-term asset, meaning something that I can turn into cash that will take me longer than a year or longer than a business cycle to turn into cash, is what a long-term asset is. Property, plant, and equipment, meaning a real estate building or all the machinery that I have to actually turn raw materials into iPads, turn raw materials into pens if I'm in the business of selling pens, or turning the cotton or any sort of nylon or any sort of material that I can turn into clothing. That's what I will use my equipment for. Goodwill, you may or may not see on many balance sheets. Goodwill is generally created when a company buys another. It doesn't have one if it has only organically grown. So in this case, this company has acquired another company, paid a premium for that company, and that's where the value of goodwill comes from. These are other intangible, other long-term assets. So as you can see, an asset, the asset section of a balance sheet is broken down into current assets and long-term assets. If you now move over to the liabilities section, you will notice that the liability are again broken down into current liabilities and long-term liabilities. The definition between current assets and current liabilities is fairly similar in the sense where you expect to pay the liabilities in the next year or in the next business cycle. That's why they sit under current liabilities. Accrued expenses, accounts payable, meaning the goods that you bought on credit and you expect to pay for those goods over the next year. If you go down to the long-term liability section, this is something that will take you a long time to pay back, hence the long-term liabilities. Examples of here would be long-term debt. If you remember earlier, we were speaking about when you want to buy your own home. Let's say the home costs $1 million, and you go to the bank and you borrow $700,000. The $700,000 you may or may not be able to pay back in a matter of a year. Typically, home loans are between 15 to 30-year tenors, meaning it will take you that much time to pay back the loan with interest. And that is something that would sit on a long-term debt or under long-term debt in the liabilities section. Now we finally move on to shareholders' equity, just a different name for owner's equity. And this is the last section of the balance sheet. So what we're looking at here is what sits here is the common stock and the additional paid-in capital. And what this really means is, for example, if I want to issue stock in the company, I can hold the stock on my balance sheet or list the stock on my balance sheet at any price I want. Let's say I want to list it for $1. However, each stock actually was sold for $20. So my common stock here will say that I had it listed for $1. The additional paid-in capital would be the difference between how much I received for the stock and how much I'm actually showing it on my balance sheet. Let's say if this was 1 and the total amount I raised from selling each share was 20, this would be 20 minus 1, or 19. And let's just say in this particular case, I had 2 shares, hence you had 2 and 38 here. Treasury stock is something that what this happens is when a company actually issues shares in its own company, and then when it is in the secondary market, it is being traded, and if the company perceives the value of the stock to be below what it should be in the company's eyes, the company manager will go out and buy its own stock. When it goes out and buys its own stock, that's when that stock sits in the treasury stock section of the balance sheet. Retained earnings. Retained earnings are the portion of the profits that a company generates on a yearly basis, as we discussed in the income statement last time. When a company earns net income each year, it pays out a portion of that net income as dividends to equity holders. Whatever is left over is reinvested back into the company, is retained into the company, and hence the name retained earnings. So what you see here is this number will grow over time so long as the company is generating positive profit and is still able to retain some money from that profit after paying dividends to its equity holders. So as you can see, for this balance sheet to balance, the liabilities plus the stockholders' equity needs to match the assets section. And if you remember what I said in the balance sheet, when you go to assets here, that assets can be bought either with borrowed money or own money, which makes sense here. If my assets equal my liabilities plus stockholders' equity, what that means is every piece of asset that I bought was with either borrowed money of $200 for this particular example, or my own money of $80. Okay, so now that, I hope that gives you a broad overview of what a balance sheet should look like. Of course, there are nuances for industries based on exactly which line items are more prevalent in certain industries versus another. So now that you have a broad overview, what I'd like to do is delve into issues of balance sheet management, specifically in the banking industry as of late. And this is a timely topic because it will show you exactly how the banking committees of several nations are trying to reduce the occurrences of financial crises that have been ongoing for the last few years. And I'm sure you have heard of the term the credit crisis that has been taking place in the U.S. So what I'm about to show you is the list of steps that Basel, which is a banking committee established in 1974, Basel is looking to take to at least address and reduce the instances or reduce the riskiness that the banks take on while generating their day-to-day business. So we covered these slides. What is a liability, owner's equity, how a balance sheet is structured, the specific line items or the subsections under all of the 3 major sections, assets, liabilities, and equities. And now let's jump into exactly how Basel III which is a third accord of the Basel Banking Supervision Committee, is debating how to lower the leverage for banks. So what Basel says is that there has been quite high leverage. There was a lot of high leverage across the banking industry. And what leverage essentially means is that for every dollar of asset that is being held in a company, more and more of that dollar is financed with liabilities or loans, then that dollar is being financed with stockholders' own money. And for example, let's just say in scenario 1, where my assets are $100, I have no debt. I have not borrowed anything from any particular bank. In that case, I have to buy all of those assets with my own money, $100 of equity. Let's look at the extreme scenario, where I have the same amount of assets, $100, I'm borrowing $90, and I'm only putting in $10. So my leverage in this case is going to be how much I have, what my assets are, divided by the equity. So I'm 10 times levered. Whereas here, I'm only 1 time levered. So what Basel is saying, that it's debating that the leverage ratio for banks is just way too high. So what that means is the risk capital that is supposed to be the buffer against bankruptcy. If you remember, we discussed how this owner's equity right here, this section is the buffer against bankruptcy for the borrowed capital or the creditors of the company. So due to the recent financial crisis that of course has been going on for the 5-some-odd years, Basel wants to reduce the risk by increasing that buffer, that is the Tier 1 capital. What the Tier 1 capital means is that there are certain types of owner equity line items, including common stock, additional paid-in capital, retained earnings, that the committee wants each company to have more of. And the more of stockholders' equity you have, the less risky it becomes for those who have lent to you, because the buffer becomes larger as a percentage of assets. What exactly is Tier 1 capital? As I mentioned earlier, it's the measure of a bank's financial strength, meaning the more owner's capital you have in here, the safer it is for that company to exist because it has a bigger buffer. And some of the examples, like I mentioned, common stock, retained earnings, they're non-redeemable, non-cumulative preferred stock. I'm sure you know what preferred stock is. Finally, the Tier 1 capital ratio. What that means is that the Tier 1 capital as a percentage of assets, retained earnings plus common stock plus additional paid-in capital, these three numbers as a percentage of assets needs to be increased from 3% to 6%. Almost, in some cases it can be 5%, but it is still a drastic increase if you understand how balance sheets at these banks are structured. The way banks make money is by maximizing however much leverage they can take so that their return on equity, meaning the return that they generate on the shareholders' equity, is as high as possible. Now, if the business that the bank can do is reduced by how much leverage they can take, that will reduce the return on equity. So here, let me actually illustrate this with the use of an example. Going back to this, in scenario 1, I said my assets are $100, I have no debt, and that means all of the money that I'm investing into these assets is my own money. Now let's say I utilize my assets generate 10% per year. So at the end of 1 year, I will have $110 as my assets. I started with 100, 10% return, I'm at 110. Now, in this case, let's just say that the cost of debt is uniform. Whatever money I borrow from a bank, I have to pay 2% interest on. That's what I mean by cost of debt. In this scenario, the cost of debt, the dollar cost of debt is 0 because I'm not borrowing anything. So the final equity that I have remaining after paying back debt, which is 0, I have to look at, okay, I generated $10 on my investment of $100, so my return on equity is 2%. Let's take the next scenario, where I say, okay, I don't have the full $100 to buy these assets, but I do have 60. So I'll go out to a bank, borrow the $40, and what I'll do is my return on assets is still going to be 10%. So at the end of the 1 year, my assets are still worth 100. My cost of debt is 2% now, as it always was. But this time the difference is I actually have to pay back not only the initial amount I borrowed, but I have to add 2% interest on that amount. So now I have to pay back $40.80, which is 102% of 40. The final equity that I have remaining is 69.2. Let's make this clearer. Okay. And the way I received 69.2 is by subtracting the cost of debt minus the loan from the value of my assets at the end of the year. So now I have 69.2 on my initial investment of $60 of equity, if you remember. That is a 15% return. And the way I calculate 15% is just dividing 69.2, which is the final equity, by my initial equity of 60 and subtracting 1. Here, the same investment, the same assets just gave me a lower return on equity because I had not borrowed any money. I had invested all my own money. Let's take an extreme case. Let's say that if I want to invest $100, I only want to put out $10 out of my pocket, and I'll go to a bank and say I'd like to borrow the remaining 90. What that does is, with the same math flowing through it, that returns 82%, a whopping 82% return on my initial equity investment of just $10. So this hopefully illustrates to you how borrowing money, levering up your initial equity investment, can yield extremely high returns if your return on assets is higher than your cost of debt. This can go in the opposite direction as well. Let's say that my return on asset was actually just 1%, lower than the actual cost of debt. Here, my return on equity still remains 1% because, hey, there's no debt. Whatever my assets return, that's what the return on my equity will be. But when things start getting rough, and I'm not generating enough, and I have borrowed 90 cents on the dollar to make this investment, I am actually losing 8% on my equity investment. Meaning I started out with $10. I only have $9.20 remaining. So that is a loss of 8%. Even though my assets returned 1%, I still lost 8 because I had to pay back 2%, which was the cost of debt. So hopefully that illustrates to you as to why Basel wants to increase how much equity these banks have on their balance sheets to buffer against the potential losses to the investors. The debt investors, that is. And like I said, this increase, by holding more equity, as you saw here when things were rosy, holding more equity gives you less and less return on equity, so long as your return on equity is higher than your cost of debt. Another issue that Basel is looking to address is saying that we want these banks to match their assets and liabilities. And what this essentially means is, think of a bank. It borrows money from investors' savings account. When you have some money in your savings account, on the back end, the bank pays you money. And that's considered to be a bank's liability. Now, that savings account can have it locked for, let's say, you have a 1-year lock on that savings account, and you cannot pull your money out till the end of the year. So the liability, the bank's liability, the tenor of that liability is, say, 1 year. On the other end of it, the bank takes that money and lends it to potential homeowners who want to buy houses. Now, if you recollect, home loans are typically between 15 and 30 years. It takes that long for home buyers to pay back the loan that they have borrowed from the bank. So what happens here is the capital generated to finance the bank lending activities, which is investing in homes to homeowners, is not paid back for 15 to 30 years. However, the bank's liability, where it is actually holding cash from investors, from savers, has a 1-year liquidity. What happens if all of a sudden investors lose faith in the bank and want to take out the money at the end of the 1 year they have invested in it? If that happens, the bank has already lent out that money, or most of that money, to homeowners. And as soon as they lend out the money, and on the other end, if the investors, if the savers want to take their money out, how is the bank going to come up with that money? Sure, it's got some equity buffer here that I mentioned to you that it can pay back from, but now it used to be as little as 3% of assets. So meaning, if the assets are $100 and the liability is 97, they only have $3 to pay back to those individuals, those savers who want to take their money out. There's just not enough cash available because all of the cash is actually lent out to homeowners who will pay back to you the capital over the next 15 to 30 years. So, of course, Basel is looking to curtail the issue there by saying, okay, number one, you need to increase how much capital you have on hand, number one. And number two, it's also saying that when you take in money from savers, you want to ensure that the individuals will keep the cash with you for a longer period of time, which is closer to the period of time that you have lent out your money. The mismatch here is that your savings account allows liquidity of 1 year, whereas your assets, your loans, which are considered your assets, have a liquidity of a much longer time period. So you want to match and not mismatch the assets and liabilities on your balance sheet. And of course, you can go through the bullet points here on your own time, but that's really the gist of it. Initially, the reason why banks liked having a shorter tenor for their liabilities or their savers is because the shorter the tenor, the less interest they would have to pay. The lower the interest rate, because it is a less risky investment. The longer the tenor, the investors need to be compensated for lending you their money for a longer time. Since the savers are only lending their money to the bank for 1 year, they don't need to have as high of an interest rate to compensate them than they would had they lent their money to the bank for 50 years. So initially, the cost of debt for a bank was very low because it was borrowing the money at very low interest rates from 1 year to 2 year savings bonds, and it was lending it out at a much higher interest rate for 15 and 30 years. This was risky for the same reasons I mentioned to you, but it was quite a profitable model for banks because things just worked. They did not break down. Until, of course, we know in 2008 when there was a credit crisis that actually began in the housing market, where the subprime homeowners were unable to pay back their loans, and that reduced the amount of interest that was received by the banks to be able to pay back to their savings accounts or just other individuals who were creditors to the bank. This forced the bank's creditors to take their money out, but the bank's money was still invested in these home loans that were very illiquid. That's what really that was the starting, if you will, of the financial crisis. So that's just going back to what I mentioned earlier. Banks may be required, according to Basel. Basel, like I said, is the banking committee that is looking to come up with these laws to to reduce the issues in this market, the banks will be required to match fund. And what I really mean by match fund is matching the tenor, the time horizon for their liabilities and their assets. Their loans, which are their liabilities, and the deposits, which are their assets. I think I said that backwards. The loans are actually their assets, and the deposits are their liabilities because they have to pay us back to save invested. So you can read the bullet points here again at your leisure, but I do want to pull your attention to the last one, where it says, it really remains to be seen how the effects of such a huge change in the banking industry, the huge change being the banks being mandated to hold an extra 2 to 3% of capital on their balance sheet, which could really have a very negative impact on the returns of equity. I want to see how such a huge change will affect, investment managers who borrow capital from banks. And when you're borrowing capital from banks, you're able to borrow at a reasonable rate because the return on equity banks is still quite high. But as soon as the return on equity is getting affected, it needs to hold more and more equity on its balance sheet. In order to meet the same return, it needs to start charging higher on the loans it makes on the loans it makes to its debtors. And the people who essentially borrow from the banks, whether they are homeowners or even investment managers who use capital from banks to leverage up their investment strategies, how exactly are these costs going to be dispersed across the industry? Will the banks just be comfortable with having a lower return on equity? Will the banks actually rely on passing those costs on to their eventual retailers, the investment managers or the homeowners or whoever else actually borrows from the bank? That remains to be seen. It's very difficult, and there's a lot of lobbying, if you will, that is going on by the current banking industry. There's a lot of lobbying happening at Basel saying, understand this is our business model from a bank's perspective. By requiring us to hold so much more capital than we do at the moment, it will really cause issues in the industry as a whole. Now, what will this lead to? It remains to be seen. But one thing is certain, that Basel is paying attention to the financial crisis that has happened and taking serious steps to ensure that this doesn't repeat itself. Or at least, even if there are crises in the future, they are not of this magnitude and they don't happen so often. So, this is a very important debate that's happening in the Basel industry. Whatever law is enacted is expected to go into effect about a year and a quarter from now, so in the beginning of 2015. So there's the entire year of 2014 is going to be very fluid in terms of the policies that are put forth by Basel. And I think that really concludes the slides that I had to present to you. And I'd like to open up the floor to whichever questions you may have, whether it is about the slides, about the makeup of a balance sheet that I showed here, or the effects of leverage in between these three scenarios.
Hi, Vic. That was a great, insightful webinar. There are a few questions coming in, so I'll just read them out to you.
Okay. Can I see, is there anywhere I can read these questions?
In the panel that you have, there's a tab called questions. So you can you see that?
Okay.
You can undock it from the pane on the second icon on the top right hand side corner.
Yes,
it's an arrow pointing outwards. Yeah, so when you undock it, you can maximize it and you can read the questions clearly. Okay, so the first question is from Virendra Verma. It says, what is capital surplus in bank balance sheet in shareholder equity?
Capital surplus. In the bank balance sheet and shareholders' equity, I mean, capital surplus essentially means, while I don't have the line item here, in terms of balance sheet, the surplus is whatever equity there is on a balance sheet. Whenever the assets are worth more than the liabilities, that's considered equity, and that's considered the buffer, if you will, between a company's solvency and insolvency.
Okay. Then that's also, is it additional paid in capital above the par value?
There's another question by Virender Verma. I hope I'm reading this in order, where it says, can you please write what are the components for calculating Tier 1 capital? So those are on the slides right here. So here you can see common stock, retained earnings, non-redeemable, non-cumulative preferred stock. Okay,
Then they ask Tier 2 capital, what components?
So I'd have to get back to you regarding the Tier 2 components. You would be able to, so this is, the way it works between Tier 1 and Tier 2 is how sure or how reliable is that capital in the company. The more reliable it is, the higher tier it belongs to. For the exact components of Tier 2, I'll have to get back to you on that.
Okay. I believe as a continuation of the previous question, Virender also asked, is it additional paid in capital above the par value?
So the additional, so that is still considered to be Tier 1 capital because the additional paid in capital portion of the balance sheet, as you can see here, is nothing more than the amount of capital raised minus the value of the common stock on the balance sheet. So as I mentioned, for example, let's just say that a share of stock or 2 shares of stock were worth $40. But on my common stock, on my balance sheet, I portrayed that each share of stock is worth $1, and since I give out 2, they're worth $2. The additional paid in capital is whatever you receive above and beyond the value of the common stock on your balance sheet, which is 38. So this is reliable capital. This is sticky capital. This is something that does not go away very quickly. That's why the additional paid in capital is still considered Tier 1 capital.
Okay. We have another question coming in from SP Vijay.
Okay.
The question is whether higher ROE with more debt is good for a bank.
It's not the question of whether it's good or bad for a bank. Is return on equity a good thing? Of course it's a good thing. The higher amount you can return on any investment, it's a fantastic thing. But the question really is, how much risk are you taking to generate that return? As I mentioned here, in this particular case, I am taking significant level of risk. I have very little equity buffer against the assets of $100, and in this case, the lowest rate of return on equity is 82% because they're able to generate a 10% return on my assets while only having to pay 2% as my cost of debt. But let's say immediately that my return on assets becomes 0%, becomes 0% every year, and then all of a sudden the return on equity is negative 18%. And this return on equity is amplified by the amount of debt I have on my balance sheet. So to answer your question, whether it is with more debt is good or bad, it's not the question of whether it's good or bad. The question is how much risky capital is it generating.
Okay, then Virender has another doubt stemming from this. It says ROC is calculated instead of ROE.
I'm not sure what the question is. ROC is calculated. Rather, would you mind rephrasing the question?
In the meantime, we can take another question from Vinod. He asks, any bank would aim for higher ROE in the interest of stockholders. How does Basel address the requirement of stockholders of the bank, which is essential for existence of the banks?
So when you say any bank would aim for a higher ROE in the interest of its stockholders, the question is, how does Basel address the requirement of stockholders of the bank, which is essential for the existence of the bank? So the stockholders, I'm not entirely sure what you mean by the requirements of the stockholders of the bank. Are you saying the required return that is demanded by the stockholders? Or is it that they want to minimize the risk taken on by the bank?
Yes, he said yes to the previous one.
Sorry, which one?
Can you please repeat what you just said?
I'm asking, Vinod, would you be able to clarify that? Rather, I see that you responded. Just give me 1 second. Let me respond to Vinod's question very quickly. So, Vinod, when you say that how does Basel address the requirements of the stockholders of the bank, are you saying that the requirements that the stockholders have on the return on capital? I see a yes pop up. Okay, on the return on capital, great. So, an investor, a stockholder of the company, will continue investing in the company if the return on its capital or his or her capital is up to his or her standards. If it feels that the banks are not generating the return that they want to return, the investor will simply take his capital and invest in different asset classes. That's the big issue that the banks are having now. They're saying if you substantially increase how much equity that we need to hold on our balance sheet, it will put a damper on the return on equity that I'm able to generate for my equity holders. And if that happens, we can see a flow, a sell-off in the equities of the banking industry, and that capital will flow to other industries. When there's a significant sell-off, that reduces the stock value or the market value of the banking industry and banks in general. So that's exactly another issue that is being used by these banks while lobbying to Basel on these incredibly high increases or steep increases on the equity being held on the balance sheet. I hope that answers your question, Vinod. Virender? Okay, great. Virender, you said risk-adjusted return on capital rather than return on equity. I'm still not sure on what the question is. I understand that the RAROC stands for the risk-adjusted return on capital, but what is your question here? We're calculating return on equity or the risk-adjusted return on capital. Those are different ways of looking at how much money I'm able to generate on how I'm looking at my equity. But the issue is whether I'm looking at RAROC or ROE. The issue is that my return in both cases, whether I'm looking at ROE or RAROC, will be damped, will be reduced by the fact that I'm not able to generate returns from as high leverage as I used to be able to. Now, because I have lower leverage, even though, so in this particular case, where I mentioned, let's just take these two extreme scenarios, where my return on assets are the same. But in this case, I have no leverage. In this case, I have a lot of leverage. My returns come down from 82% on equity to 10% on equity. How I want to look at this, whether it is through the risk-adjusted return on exactly which types of assets I hold, or I want to simply look at this and say, forget that the risks underlying my assets, I'm just looking at the return on equity. That return on equity is just so significantly lower because I have to reduce the amount of debt I'm holding on my balance sheet, thereby reducing leverage, and thereby reducing how much money I'm able to generate for my equity holders is what is causing an issue in the banking industry. And of course, this is an extreme example that I'm showing you here. The difference is not this vast. This is just for illustrative purposes. Rather, does that answer your question? Okay, great.
Okay, so I
believe that we have some more. Sorry, go ahead.
Yeah, I believe that there might be a few more questions coming in, so we'll just wait for 1 or 2 minutes so that people can type out another question in case they have.
Okay. Yeah, if anyone has any other questions, I have a few more minutes here on the clock, so please let me know.
Okay, I don't think there are any more questions coming in. And since no other hand is raised, I'll assume that nobody else has a doubt. So I believe that brings us to the end of this webinar. And thank you, Vic, for this amazing, insightful webinar. It was really interesting and, in fact, really amazing. Also, thank you, everyone, for attending this webinar. Have a good day.
Thank you. Have a good day.